This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and once again, we are joined by Gil Figueroa, president of First Commercial Capital. Okay, so let's just talk about the real estate part of the business. So residential real estate. Let's go there first because I'm really familiar with the numbers. So you have about, let's say collectively you do $1 billion of business. You're now doing 550,000 or a million instead of $1 billion. So you're doing 45% less volume in actual volume of sales. And then you have a price decline of about 5%. So your revenue is gone down 50% for the whole industry. You can say they're still fully employed, but it's BS. If they have 50% unemployment, that's literally the number because that's the revenue cut.
No, I agree. A lot of firms have gone under, as you know. There's a lot of mortgage companies that have cut employees and production is down at least 50%. I agree wholeheartedly.
Yeah, well, I wasn't thinking about the lending side, but yeah, that's another group of people that will be, say, exiting their office space or downsizing. So that's a category. So does a lender typically do one product? So let's say if I'm in the office lending business, am I doing apartments as well? So there's a contagion that's possible. Like if that side screws up, it impacts the whole.
Pretty much, yeah. I mean, the majority of lenders have an array of product line they lend on, but over the last, I'm going to say 10 years, they've really concentrated on multifamily. So a lot of the lenders are coming out with multifamily products, but for the most part, most lenders will still do another product, maybe some retail, maybe some mixed use. So they do have, product overlay. And you're right, there is some contagion over office and so forth. Some lenders in a better position than others, depending on their portfolio. So it just depends, where how aggressive they were. But I can tell you over my 10 or 20 years, I've yet to hear a lender tell me we're big on office. I think the last time I heard big on office was 2007.
Right. And they paid for that probably a lot.
Right.
Okay. Well, my office building would be a case in point. That I bought it. It sold for $1 million in 2007. A few years later, I bought it for $319. Sold it last year for $1 million. Now that guy's going to be at the other end of the spectrum. And what was really odd, and this is probably why lenders are careful, is that the building behind me that he bought and then bought mine was vacant for 8 years without a tenant. That's unbelievable.
That's unbelievable. Somebody didn't do their homework.
No, no. Yeah. But yeah, and I think that was considered an A type structure, but it never got occupied. It got sold. It got sold at a discount eventually. So when I was looking at that going, wow, that doesn't create a lot of cash flow.
Was that in California or in Florida, Bruce?
No, it's California. That was in Riverside.
That makes sense. Yeah, that makes sense.
Yeah, that was crazy. So when you fund a loan, that paper is held often by commercial lending local banks. Is that a local bank that's funding that?
Yeah, the majority of lenders we use are local banks. They're more aggressive. We do use agency as well. And by agency, I'm referring to Fannie Mae and Freddie Mac. So we do use them. And the majority of loans, I think where you're headed with this question, are underwritten based on Fannie Mae and Freddie Mac guidelines, because a lot of lenders have the ability to sell seasoned loans for premiums to Freddie and Fannie. And that's a whole other market, the same way that single family would work as well.
What would be the typical length? You've mentioned a 10-year, but that seemed like, wow, that's a special product. Is there a more common range of time when somebody took out a loan? Is it more common to be 5?
Yeah, 5 is the most common. I would say 75 or 80% of investors pick a 5-year. There is 3-year financing. There's even adjustable financing. There's 7-year. There's 10. A 30-year product is available. Over a $2 million loan amount. So it is available under agency. You're using a 30-year bond, so the pricing gets a little stiff. A lot of investors don't use that route for the most part. I mean, I've probably done 2 in my career, just to give you an idea. But the majority, I would say, is 5 and 7-year money.
Are these loans almost always variable?
Well, they're hybrid. So we're talking about 30-year amortization for multifamily. Office, you get into 25-year amortization. But for multifamily, it's 30-year amortization. If I'm referring to a 5-year product, I'm referring to fixed for 5 and then hybrid. And what hybrid means, we're going to adjust to an adjustable, which is typically a 6-month LIBOR or a SOFR loan, and with a 2.5 or over spread. So that's where, some danger is coming, because obviously these are going to reprice quite a lot higher now on that reset. Again, I'm pushing investors to look at that. And if they need to be proactive and refinance prior to their adjustment period, if it makes sense.
Do they have to requalify, or the lender they've got the position they've got, the number goes up, but the owner doesn't have to requalify again, or they do?
That's a great question. And that's something that people need to know. I'm glad you asked that, because if you read the trust deed, it doesn't say they have to requalify, but they do have to maintain the same debt service. So by that, it would mean that if they haven't adjusted their rents appropriately for this product to be in approval debt service for that particular bank, they can be, in essence, in default.
Wow.
So the lender can call the loan
right
legally if their debt service is not within, their hurdle rate. So they would have to either increase rents, decrease the loan amount to keep within the lender's parameters.
Is it in the lender's choice, or is there oversight of the lender that could force not good decisions upon the lender? In other words, is there some governing agency looking at these books going, hey, you don't want to let this slide? I'm wondering if there's
That's a good question, probably above my pay grade. I don't look at that, but I would assume so, that it's the same as Fannie and Freddie single family. Wouldn't single family have that as well?
Well, usually that's fixed. This is a different world. And by the way, you and I didn't prep any pre-questions, and so don't feel one bit bad about, because I've looked at this thing. I'm trying to think, okay, where's a possible damage path for other things? Remember in the residential world, when we had those movies that came out, and there were all kinds of odd collateralized debt obligations, where there were almost like bets against the outcome of the success of the loan program. And so is the commercial world going to be impacted by any of that, where somebody said, okay, let's bet against the outcome of that package of loans, that type of thing?
That's a great question. More of a Wall Street question. I don't know what products exist to short, collateral on multifamily or commercial for that extent. I'm sure after the '08 debacle, there probably does exist some type of product line to be able to bet or short that marketplace. I would assume so, but that's an assumption. I don't know. I mean, I guess you can short REITs, and other product line. I mean, I'm assuming there's a product after '08 and what happened in '08 where many investors, did develop that line of product.
Well, it was kind of crazy how I figured out collateralized debt obligations. I'll just tell the story because I was having a hard time even with the concept. But at the time my daughter got married, when I paid for the wedding in advance, I got this mailer, and it was, well, what if the wedding doesn't happen? And they said, you can insure against the outcome, pay $500. And if it doesn't happen, we get to give your 25 grand back. And I thought, that's a good, I'll take that. But then when I filled out the application, it was really strange because it said, like, who are you in the food chain? And I thought, that's really interesting. I could literally get a room full of people, make copies of this, and I could have 100 people bet against the outcome of my daughter's wedding. And then I could control the outcome of the wedding. That's a collateralized debt obligation. That's really scary stuff.
Sounds like a Las Vegas bookie to me.
It is. It was crazy. But that when you started understanding the Wall Street stuff that they were doing, they were giving AAA ratings to paper that was terrible. And they had their clients do one thing and they were doing the opposite bet. Unbelievable. So I guess that's why and this is very specific to thinking about systemic risk, to be honest with you. That's what I'm trying to look at and say, okay, is this going to be a snowball that's a problem?
Well, I mean, we can have two conversations. My bases of analytics go between 3 and 6 months. So it's hard for me to kind of guide from that point on. So right now we feel that we're going to have treasuries in between a 3 and 4% for probably 3 or 4 months moving forward, a kind of a sideways roll. Not to say, and our analysis is showing this to be a fourth wave, which there could be a bigger wave coming up that pushes us over the high of 4.33 on the 10-year treasury. I think that's coming. I think there's inevitable. When is the question? So we don't know when. So if we're having problems sustaining debt service or bank reserves now, right? So if rates were to shoot up to 4.5 or 5% treasury, will we have more problems? I would say that's a logical bet.
Okay. Now, so, and you've been pretty right on everything you've ever said about interest rates. So the 10-year T-bill is about what, 3.2?
I think today we're at 343.
Oh,
so
okay.
To be exact. And today we had a CPI come out, which CPI was nice and not too bad. We had only we had 10 tenths, 1/10 of a number come in lower than last month. And now our CPI number, inflation's 5%. So it's a little softer. So it's a little softer on inflation. The feds are looking at rents and new car purchases to be the biggest gainer on the CPI numbers right now. So rents are still pushing the envelope where feds are not happy.
Yeah, but isn't that a lagging number? I'm just curious.
It is. Yes.
Yeah. Okay. Yeah. So that's not a current number. That's
right.
That's an accumulative 12-month number. And you keep on dropping off the high number and getting probably a zero over here.
Well, it is month to month as well. So there is an analysis month to month.
Okay.
Yeah.
Okay.
Yeah.
So what would be the rationale for, you think they're going to just keep raising rates then? You think the Fed's going to keep raising rates?
No, I personally think, and right now, not only I, but if you look at CME FedWatch, there's what's called a FedWatch tool. And that FedWatch tool will give you a analysis of what the potentials are for another Fed hike come, let's say, 1st of May or the 3rd of May to be exact. Okay. So right now, that tool, based on CPI numbers today, we increase the 7% chance that the Fed will not make a move. So right now, we're at 34% of the consensus to state that the Fed won't make a move. Okay. Now, with that being said, we're still 60 plus on a quarter move for that next move. Okay. So my point is, we're watching the Fed watch. I'm watching the charts. I'm watching my analysis. I think we're going to be soft. I think we're going to be soft for the next 3 or 4 months. I don't think the Feds are going to move aggressively, if at all, or the market is going to aggressively move itself, because treasuries are not controlled by the Fed, so to speak. It's an open market trading. So as the Fed's moved since the last increase in October, since October, we've had rates going down, the 10-year
Right.
Treasury going down. So
Right.
hence, the market has its own ability for flows and ebbs, not just Fed controlled.
But what you're saying, and the time frame that you're talking about, seeing this 10-year go into 4.3 to 4.5, what's the time frame for that, and what's the reason it does that?
Okay. Well, I mean, frankly, money flow is the problem, and that's really what happened to the banks that became insolvent.
Right.
So unless lenders create more money by lending more, then the money flow problem just increases, right? So this lull in the market, this deer in the headlights with rates coming up, has the obvious reaction of slowdown, right? So if we have a slowdown, we have less lending, in essence, less money supply. So with less money supply, money becomes what? More expensive. Kind of just the law of supply and demand. So that
don't assume any of this is absolutely easy for me to comprehend. It is not. When last time you and I talked, I wish I had the sheet. I had a whole sheet. You and I were just talking, and you were talking about what you know, and I'm writing notes. I had a whole page of notes. So, it's really interesting. I'm trying to see how you can have an economy that's, let's say now it's at 5, which I think it's going to be headed down, but the 10-year is going to go up. And that's because the supply of money is diminishing.
Right. So when money as any product line diminishes, right, it becomes more what? Expensive.
Okay. I'm trying to go backwards now.
Yeah.
I'm trying to think of fear. So let's say there's something like the Fed's all of a sudden goes, okay, wow, we're going to have a recession. We're going to lower rates. Does lowering rates create more money?
Only if more lending happens.
Right. Okay. Yeah.
Yeah. So if more lending happens, yes. I think we're going to see something different in the marketplace because, I mean, I don't know if I should put this out on the radio, but the reality of fractional banking, any bank can have a run. There is no safe bank.
Yeah. Well, it's kind of funny you say that because we sold a residence and I had a lot of money in a bank, probably about a week before it hit the fan. And I thought, that's probably not a good idea. And I move it all. And then this happens, and I'm going, holy cow,
Well, the first thing that happened after these banks, when it, had their problem, is everybody shifted all their money in the big banks.
Right.
So the question is, putting all their money into big banks, then big banks are going to have the same problem the little banks had because they're going to be too liquid, in essence, right?
Yeah.
So they're going to create the same issue. So the question is, when are people going to acknowledge this and then get into tangibles? Well, Bitcoin's up, 30%, 28%. They're up. I'm thinking the stock market's going to go up as well. I think we've seen the low. The low we saw in October is holding. And I know that sounds outrageous, but if you look at high yield bonds, which is in essence a junk bond, we've maintained higher, thresholds since October and moving up. So people are buying the product. So there's a lot of bullishness in tangibles. And I think when the bank is not a safe hold, so to speak, as people think it is, you're going to see the market move up on a different emotion. The market will move up because of fear, not because of greed. And that's completely not normal, so to speak.
Well, that's an interesting thing that you just said. So we created a matrix called a moodometer, but it literally is what is the group of buyers willing to pay as a percentage for residential as a percentage of their income. So in four times, 1980, 89, 05, 06, and 2022, that number represents 60% or more of their gross income collectively. Now I know you can't qualify for it, but that's the number. Okay. Well, what happens the other time? Well, your peak mood is only there because of competition and excitement, and you've got to have one. All of a sudden that disappears. So when it's on sale, and on sale was 2009, instead of 70%, it's 28%. And it's such a bargain price, everybody's fearful, and we have to pay them $8,000 to bribe them to buy one at a price that's 60% less than the peak.
Wow.
That's human nature. So, okay, so what we're about to do, and this would be something if you could help me, I would like to create for the two spaces that you're most familiar with, the apartments. I'd like to create a moodometer for apartments, and how we would do it is we would play with, so like with the moodometer for the residential, we have earnings, we have interest rates, and then we have a historical mood. And your historical mood, that would be the number of cap rate. That would be a cap rate that we could plug into this and say, okay, well, if you're in a mood to pay a 3% cap rate, but interest rates go to 7, and you're in your top mood, let's say, then this will be your price stability. But what if your mood is different? The rate is 7, but no longer are you at the 3 mood, like the 3 cap mood, you're at a 6. We can play with those numbers and determine the damage path of that asset.
That's very interesting. I'd love to do that.
Yeah, well, if you can help me create that, because that's why I called it the moodometer, because it tracks the mood of the participant. And you just said that's an element, and it is. Absolutely is.
Yep.
Bruce, I have 2 questions. Gil, in your world, do global threats or global events affect you here locally? The war, the fear of, us losing the world currency, any of those things, did any of those things affect you? And then I have another question.
Sure. Well, Joey, that's a good question. And that's somewhat what I stated, that I think values can still go up, and the stock market could still go up. And that's because there's going to be fear of losing. So people will buy a tangible product, even though maybe not the cap rates, the cash flow will be there, but it's tangible, and it'll have a return, right? Or it could have a return in the future, and it'll always be worth something, so to speak.
Right.
So I think there's going to be a turn where people are buying because of fear instead of greed, and that's what I mentioned earlier. And I think that's where we're headed. And I think we're seeing it somewhat in the crypto market. The crypto market's been decimated for a year, and now it's up 30%. So people aren't buying crypto because they feel that it's going to all-time highs yet, but they're buying because they fear their money in other sources.
Right. It's a defensive buy, like gold and silver are very high right now. And yeah, same type of thing. I'm holding it. I have it. Well, of course, you don't hold a Bitcoin. That's the only part that bothers me about Bitcoin. Can I have one? No.
I'll send you one, Bruce.
Yeah, well, then it'll be artificial.
So, Gil, my other question is, I deal with a lot of the investors, and a lot of them have been, single family, small mom and pop. Some of them have grown their portfolios and been very, very successful. And a lot of them, it's almost like a natural progression for them to go to either commercial or multifamily. How difficult is that transition? And does the leverage help them get there, or is it harder to get the leverage because of, where they come from?
Okay, so as far as qualifying, lenders look at, the same criteria. They look at single family. They'll look at, net worth. They'll look at, a debt service and a debt ratio for the client as well. So chances are, if they were buying single family and they have a nice portfolio, they're going to qualify for multifamily. It's not a big deal. Now, net worth, I think, is the only one thing that's different from single family to multifamily. So a lot of lenders have a net worth requirement. So if you're borrowing $1 million, they want to make sure you're worth $1 million. So that's probably the only caveat that's a difference. But qualifying is easier than a 4-unit, because now they can go globally up to 80% debt ratio. Basically a 120 debt service is an 80% debt ratio. And where single family, you're limited to probably what, 45%, somewhere in that range. So qualifying for a multifamily as a client is easier. Now, the asset will determine the loan amount, though. So the net operating income will determine the actual loan amount. So in essence, a client's worth $10 billion. He's not going to get an 80% loan to value if he's buying a 4-cap deal. He's going to have to put 40% down or 45% down. So the asset will determine the loan amount, even though you have a very qualified buyer. Very different than 1 to 4 unit.
Do you typically get a lot of people that float in between that world, between the commercial space and the single family? Or is it once they make the move, they're like, oh, I love this, I'm going to stick to the commercial?
I mean, I'd say high percentage of them that come into commercial and understand the metrics, right? Management metrics, how to have one building with 32 doors, 40 doors, and be able to maintain it cheaper than having 32 homes separately, right? They don't have 32 roofs. They don't have 32 plumbing situations that can go wrong. They only have one, right? Under one roof. So when you do the metrics of management, then the math pays for itself and the understanding of the math. So in essence, yes, most of them stay to the multifamily world. I've never seen one regress. How's that? Not one.
That is true.
Yep.
Yeah, that is true. And even people, Joey, even people that have 50 or 100 houses don't usually make the move to apartments. And I think it's just a match from the beginning that you're pursuing a product type. And
it's funny you say that, Bruce, because I don't get that question, or I don't get that feeling from seasoned, older investors. I get that from the ones that are like new. Hey, I'm jumping in, I'm buying, and then I'm gonna do this for a couple of years, and then I'm gonna get into commercial. I'm gonna get into multifamily.
Okay, yeah, the people that I know that were like Tony Alvarez, how many commercial buildings does he have? None, unless he's occupying it. He's basically got fourplexes to single families and tons of them. Mike Cantu, on and on. The same that when you think about people that have dominated an industry in California, and then same with Florida, John Schaub, etc. They have single families because that's the product they know. And so the guys that own apartments, that's a different strata that they got used to.
Do you remember I asked John Schaub about what's his biggest mistake of his career? And it was getting into that world when he wasn't ready.
Oh, the multi-unit?
Mm-hmm.
Yeah, that's right. He did that early on and had location's kind of important, so that's a problem when you have 50% vacant and nobody wants it anyway. Yeah. Yeah, that's a tough lesson.
Well, it's a learning curve. You're getting into a different product. You have if you ask me, you have a different grading on your client. So a client that can qualify for a $3,000 rent compared to $1,500, you have a different grading system. So I would assume your grade on single family is probably a little more stringent as getting the home versus getting an apartment renter. So, some people are more comfortable with that grading. But then again, when you become vacant on a house, how fast can you get it back on the market? There's another question where an apartment typically has a faster range just because there's more people able to afford it.
Okay. All right. Well, Gil, thanks. I really appreciate you taking time today. I've enjoyed it, and I appreciate your expertise. And I'm going to take a look at that 10-year T-bill chart and hope you're not right.
Well, and again, that's not right now, but right now is a great window of opportunity to refinance, even though a lot of people don't understand that is. People are waiting for 3% treasury, a 2% treasuries to come back. And I think that's a very long-term wait, if ever. So that's kind of a big statement on my part. I think it's a great time to refinance right now and stabilize yourself and have a game plan. More importantly, have a game plan. But Bruce, I've always appreciated you. I went to the California dump. I think it was in 07 or 08. And I did well listening to you. So you're one of my heroes,
That would have been a better title, Bruce, the California dump.
Yeah, we called it the crash, but yeah, we should have done parentheses. Yeah.
Yeah.
Gil, I've got not in the context of what we have on air, but the Japanese economy boomed and then basically languished for 30 years. And they went to zero interest rates and enormous debt, right? So that's where they're at right now. They're like their GDP to debt ratio is way over twice what our country is, that type of thing. Why did they choose that route as opposed to, just having a crash and raising interest rates and then starting again? It's like they went to zero rates and just parked there.
Well, I mean, I think that's a more appropriate call than crashing if you can do it. If you can do it, and I that's above my pay rate. Why they were allowed to do it on a global scale and still be somewhat, not turn into grease, right? So that's way above my grade. I don't know why the Japanese economy could do what they did, yet a country like Greece couldn't handle that, right? So
why couldn't we? I'm just curious. Why couldn't we handle that? Would we lose like the world's currency status?
Well, I mean, you could lose currency status. You can lose grading status, right? We can be instead of a AAA bond, we could be, double A or even a B bond, right? So we could lose rating status, and there's Japan was never the leader, right? So
they weren't.
So my point
world's
is
currency, yeah,
right. So by us being the leader, there's a lot of pressure because number 2 or 3 is way down the scale.
Right.
See my point? So being the leader, you're not just being graded down to second or third place. You've lost a big threshold in market share.
Well, the title of this next report is "What's Next? A Lost Decade or 1% Mortgage Rates."
Well, after our 5th wave, when we hit a new high on the treasuries, we expect a 60% drop
of the 10-year T-bill.
Yep.
Which gets it into the mid ones.
Well, if we're in the
below
5s,
2.
it'd get us into 2.
Oh, 2 anyway. Yeah. Okay.
But that could be, how much time we don't know. So that's the part we don't have a handle on yet. I'm looking into how to predict time as well, but that's a different monster.
Yeah, that's a monster when you put it. Nothing like putting California crash on a page on a title of a 400-page report when in the middle of a boom. That's not received well until it's actually come to fruition.
100%.
Yeah. All right, Gil. Thanks so much for taking time today.
Thank you, Bruce. I really appreciate it. Thank you.
I enjoyed it. All right. We'll see you.
Take care.
Bye-bye.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.